All right, well, those are the big headlines that we are tracking for you at this hour. Well, let's kickstart the show and first up introduce a very different concept that we've brought for you on the Money Show. Like I told you, in 2020, if we talk about what really has been the theme that played out, it's got to be risk taking. If you had invested in risky assets at the height of the pandemic in March, like Bitcoin, like equities, they've actually managed to give you way better returns than the relatively safer assets like gold. And yes, I say that even though gold hit record highs during the year, but it's the Nifty, the Sensex, the Bitcoin as well. If you had just invested in these benchmarks, it would have surpassed the return through and through. So perhaps for the year 2020, it was all about risk taking. But what will be the theme for the year 2021? It looks a little unlikely that equities will continue their stellar run up from our conversations with market participants. But the one thing that will work to conserve, to create and multiply wealth is diversification, and that's going to be the Money Show's theme for 2021. How can you diversify investments? Looking at options beyond just equities. These are some of the topics that we will explore over the course of the next few weeks on the Money Show. So on today's topic of diversification, we are going to introduce foreign investing. What are the ways to invest in foreign stocks, foreign markets, foreign bonds, and what have you? Is it safe for you to invest? How much should you invest? What are the risk factors? Is all that we will be discussing. Remember that to invest in foreign markets, thanks to, of course, the advent of fintech, thanks to, of course, a variety of other innovations brought forward, the borders around investment have come down. Most of us, in fact, don't have any foreign assets in our portfolio. So you not only are missing out on perhaps, return opportunities in these foreign assets, but there's no geographical diversification in your portfolio. Where and how do you invest? Well, you can of course invest directly in stocks, but if you believe that you don't have the know-how to do so, there are feeder funds and mutual funds. Motilal Oswal, Kotak has recently launched one, Franklin Feeder Fund. There are several mutual fund houses that have foreign stocks in their portfolio or are essentially oriented around foreign stocks. There are country-specific ETFs as well, Nasdaq ETF, Russia ETF, and what have you. And then of course we have some funds with a good 25% of their holdings in foreign stocks. I think one of the most popular examples, and we've brought on board this fund in our Meteor Fund Manager segment as well, is the Parag Parikh Long-Term Fund. So that's of course about the ways to invest. However, it's important that before you consider investing in foreign markets, there are several things to watch. Firstly, fee structure. Secondly, the currency risk, because obviously you'll be invested in pounds, in euros, in dollars, ruble, what have you. And thirdly, of course, gauging the success of the product in India. The AUM of these products has been a little lower because you don't have much of enthusiasm in these products, at least so far. But it's once again, as financial awareness as well in India is picking up, it's slowly picking up. So anyway, let's take forward this topic a little more on foreign investing with Viram Shah, the CEO and co-founder of Vested Finance. Viram, thank you so much for joining us today on ET Now. So, I think I spoke quite a bit about foreign investing, but, why don't, I'm sure our viewers will be much more convinced when an expert talks to them. So tell our viewers on why it's so important, to have geographical diversification. This is an element I think that's missing in a majority of Indians' portfolios.
Yeah, firstly, thanks for having me here. And I think you've picked the absolutely right theme for 2021 of diversification. That's something that's very essential for every investor. And the way we look at it, basically, there are these 4 pillars of diversification. The number one is looking at different kinds of assets. So asset-based diversification, which means that, as you said, you shouldn't be investing all your money in equity. You could look at different classes such as bonds, real estate, gold, etc. The second diversification pillar is industry-based diversification, where you put your money into different industries, so such as financial services, IT services, pharma, etc. The third is time-based. So you don't want to put all your money in one go. You want to spread out how you're investing the money. And now the fourth pillar, this is the pillar that's been missing in a lot of our portfolios, is geographic diversification. Basically, you shouldn't be having all your money held in one currency or held in one market. You should have some part of your portfolio diversified in other markets. And that is what geographic diversification is is all about. And now, because of technology, it's become much easier to also invest into funds that are in India, investing internationally, but also directly investing. So you can actually open up a brokerage account outside of the country in the US and start investing internationally.
It become extremely simple now to invest in foreign stocks and foreign assets, and yeah, essentially that's really something that we've tried to establish as well. So I want to understand, from the legal angle as well, what does the law say currently? How much money can you remit abroad? Because there's that bit as well to take care of.
Yeah, so say somebody wants to invest directly in the international markets by opening up a brokerage account. You can invest as an Indian resident. Every year, you're allowed to transfer up to $2.5 lakhs. So that's $250,000 under the RBI's liberalized remittance scheme. So basically, what this scheme governs is what is called a remittance, which is how much money you can move outside of the country. And so under this scheme, there are different purposes that they have allowed. So there is education, there is travel. One of these purposes is also a portfolio investment abroad. So legally, you can do up to $2.5 lakh per individual. If a family is looking at it, we see people allocate about up to a million for a family of 4 to invest internationally.
So, investing obviously in direct stocks sometimes could be a little tricky, especially for those retail investors who may not be savvy really with the stock market. I mean, sometimes we're a little worried about how they'll handle the Indian stock market. So foreign stock markets, of course, is all the more a little tricky. So where do you advise they start off?
Yeah, that actually is very true. And that's something that we talk to our customers about a lot. The way to start when you start in a completely new market is not to dive deep into stocks and suddenly take a lot of risk. The way to start is basically looking at ETFs. So ETFs in the US are very varied, and there are a lot of different options available. So a simple way for somebody to get started who's dipping their toes into the US markets or international investing for the first time, they could basically look at picking, let's say, 3 ETFs which invest across. One is in equities, one is into a debt or so a bond ETF, and then lastly, they could look at gold as a small allocation. So just picking these 3 ETFs and creating a portfolio as per your risk profile. So you spread the investment into each of these based on the amount of risk you want to take. That's the easiest way to get started. Then as one gets more and more familiar, they study the different companies, the different opportunities, they can start diving into a little bit of direct stock investing.
Okay, all right. So that's of course about how should you go about and kickstart your entire investment process in foreign funds. So Viram, stock markets, foreign-oriented funds, ETFs. If you could just sort of share with us, a little bit of each of these, and what would be the suitability of each of these foreign investment avenues for our different viewers and retail investors.
Yeah, happy to. So there's basically, when somebody is looking at international investing, there's 2 ways they can go about it. One is they can go the direct route, which is you open a US brokerage account through a company like ours and invest directly into the US markets in dollars. The other route is investing through funds that are available in the India market, which are investing internationally. So these are the 2 options that one could look at. And both are good options. Both have its pros and cons. So for example, if somebody is looking to go direct, invest directly into the US markets, they get a lot more diversity. So basically, if one wants to invest into different types of companies, say an investor is super bullish on Tesla, for example, and they want to allocate a significant portion of their investment into Tesla, then investing directly allows them to do that. It gives them that flexibility. Whereas if you're looking at funds as an option, they limit the flexibility, but then it's much more convenient. You don't need to have a new brokerage account. You don't need to transfer dollars to start investing. It's an easier way to get started if you're investing directly in a fund. So these are the 2 main options, and one can pick according to how they want to create a portfolio, which one of them is better for their needs.
Excuse me. Okay, understood. All right. Viram, would you recommend foreign investing for someone with a bit of a lower risk appetite? I mean, I know you sort of flagged off the various differences, but in general, the concept of foreign investing, should those individuals who have a lower risk appetite, maybe, they've already retired. Those could be people who are considered as, low risk appetite people. Do you recommend they should, sort of explore this foreign investing topic?
Absolutely. In my opinion, across risk profiles, everybody should have some kind of a foreign exposure. Now, how much risk you're taking in that foreign exposure is up to the investor, right? So any risk profile investor can add a foreign investment allocation, and that is where again direct investing gives that flexibility. So, for example, if somebody is a low risk person, doesn't want to take a lot of risk in their foreign portfolio, what they can do is get started and they don't need to invest in equity. They can, for example, just say invest into US Treasury ETFs or invest into an ETF that, say, for example, Vanguard's Total World Bond ETF, which invests across debt products across the world. So they can create a portfolio which is conservative, but then also take the benefit of having that fourth diversification pillar, which is geographic diversification.
So how much of a portfolio do you think should be used to sort of, invest in foreign stocks, funds, what have you?
Yeah, so we've typically seen investors allocating about 10 to 20% of their portfolio to geographic diversification. So having an international exposure in about 10 to 20% of their portfolio.
All right, 10 to 20% should be, an okay amount to sort of experiment with foreign investing. Well, if you've got any questions on investing in, markets abroad, you can write them into us. Our email address is themoneyshow@etnow.tv, and we will get Viram Shah to answer them. Where to start off? How should you go about the nitty-gritties? Send them in. Our email address, let me reiterate once again for our viewers, is themoneyshow@etnow.tv. Okay, well, let's take on board our first query of the day. Vilas Dole writes saying, what's the expenses involved in investing in US or foreign stocks directly versus the charges that fund houses of these foreign funds charge? That's actually quite a valid question. If I'm directly investing in stock markets, all the ancillary charges, exchange fees, commission, brokerage, versus, what I have to pay a fund house. So, for example, a Franklin feeder or a Kotak Nasdaq, Motilal Nasdaq, what would be the expense ratio of these funds versus the expenses involved in buying a foreign stock directly, Viram?
Yeah, that's actually a very good question. And so the way you can look at it is basically when you're investing directly for, say, a platform like Vested, there is no commission. So you don't pay anything when you're buying and selling. So then the major cost that is involved in the process is when you're moving the money. So when you're actually moving INR to US dollar and then bringing the money back. So the remittances essentially are the biggest costs that are then involved. And these are one-time charges. So when you're moving your money into US dollars, typically you get charged a fixed fee of 1,000 rupees, and there is an FX fee of about 1.5%. This varies according to the bank and how the relationship you have with the bank, but this is approximately what you get charged. There is also a fee when you bring the money back. So when you're bringing your money back in rupees, there's a fee of you get charged about 700 rupees, and the FX fee is lower. So the FX fee is about 1%. So that's a total of about 2.5% and the fixed component. Now, these are one-time fees. So if somebody's investing for the long run, 5 years, these are actually just fees that you'll end up paying only once. You can keep the money in US dollars for however long you want. Now, if you compare it to a fund, on the other hand, they charge typically an expense ratio of about 1 to 2% every year. So that means, say, if you're investing for a 5-year horizon, you pay a 10% fee for the fund because it's an annual cost. So this is how it differs. So if somebody is looking at it for the long term, actually investing directly might make it much more cost effective if they're not withdrawing or depositing money constantly.
All right. Okay. So that essentially it would vary depending on how much you are, how you're investing your money. Okay. Prasad T says and asks rather, is there a minimum investment amount required for foreign stocks, Viram?
So there is none. Actually, that's one of the barriers that existed. Say, let's say 2 years ago, if somebody wanted to invest internationally, directly opening a US stock account, a US brokerage account, you would have had to have about like 100,000 minimum requirement to even start. Now, what technology and essentially fintechs have enabled is that you can get started essentially with no minimum. So you can even start with $200 or $500 and keep building your portfolio over time. Just what you want to be careful about is the costs that are involved in the process, so that if you're starting with very small amounts, the costs are not feasible. So you'd rather want to start with one larger amount and instead of sort of spreading it out across smaller amounts.